Hello, students. Hope all of you are preparing for your exams. As I told you, I will be sharing the few videos on technical analysis and fundamental analysis as it was not covered in the class. Anybody who is investing in stock market or who has already invested or who wants to invest in stock market will be having many worries like there would be crisis in the economy, in the developed economies, which would affect the entire economy of the other countries. Like developing countries like India would affect due to the crisis in the world economy or US economy, etc. Not only that, even the investors have worries about foreign institutional investments, and even the foreign institutional investors will also have some doubts about their investment due to so many factors which impacts the stock market. So in this video you will be getting a overview about what is fundamental analysis, how it affects the stock market, that is how the various factors or how the economic factors will affect the stock market or the share prices that have been listed in the stock market. So let us see, in this module I will be covering your various uh, topics like economic and industry analysis. That is, we will be discussing about macroeconomic and industry analysis, that fundamental analysis, that is the economic, industry and company framework. Then I'll be discussing individually the economy analysis, what are the factors that affects economic factors that affects the share prices in the stock market, what are the industry specific factors that have to be analyzed, and also the company analysis. Also, I'll be discussing about the market efficiency, that is efficient market hypothesis, forms of market efficiency, and I'll be discussing about technical analysis, which is entirely different from fundamental analysis. I'll be giving you an overview of what is technical analysis, the theories, the basic theories behind technical analysis like Dow theory, Elliott wave theory, charts, different types of charts that are used to analyze the exit and entry points, then trends and trend reversal patterns. Also, I will be discussing about mathematical indicators like moving average, convergence, divergence, and relative strength index. To start with, what is fundamental analysis? See, the intrinsic value of a security or specifically equity share depends on a multitude of factors like earnings of the company, the growth rate, etc. It also and we also should note that risk exposure of the company have the direct impact on the prices of the shares. All these factors in turn rely on the many other factors. It would be uh, like in the economic environment in which they operate, the industry they belong to, and the company's own performance. All these factors affects the prices of the shares. So fundamental analysis is very important, and also the fundamental analysis is the analysis of the important factors that affects the value of the stock. The appraisal of the intrinsic value of shares is done through economic analysis, industry analysis, and fundamental analysis. So, fundamental analysis is what? It is a technique which attempts to determine the security's value by focusing on underlying factors that affect company's actual business and its future prospects. So why we need to make fundamental analysis, conduct fundamental analysis? So fundamental analysis will answer questions like, is the company's revenue growing? Is it actually making a profit? Is it in a position strong enough to outrun the competitors in the future? Is it able to repay the debts? Is management trying to cook the books, or is its financial statements are fair enough, which depicts the true position of the company? So fundamental analysis will answer all these questions. Fundamental analysis can be composed of many aspects: the analysis of the economy as a whole, the analysis of the industry, or the analysis of the individual company. So it comprises of all these analyses to arrive at or to predict the stock prices in the future. Students, fundamental analysis is a combination of economic, industry, and company analysis to obtain the stock's current fair value and also to predict the future value. And this kind of fundamental analysis is known as top-down approach. Why? Because the analysis starts from an analysis of the economy, it moves to industry and narrows down to the company. And hence it is called EIC analysis. So to start with, let's start with economy analysis or economic analysis. What is economic analysis? It is the study of the general economic factors that helps to evaluate the security's value. Why we need to make an economic analysis? So, as we all know, stock market is an integral part of the economy. When the level of economic activity is low, stock prices will be low. And when the level of economic activity is high, stock prices are high. An analysis of the macroeconomic environment is essential to understand the behavior of stock prices. And the commonly analyzed macroeconomic factors are, as you are looking on the slide, gross domestic product, savings and investment, interest rates, budget and fiscal deficit, tax structure, balance of payments, foreign direct investment, investment by foreign institutional investors, international economic conditions, business cycles and investor psychology, monsoon and agriculture, infrastructure facilities, and demographic factors. All these affects the stock prices, and hence it is important to analyze all these macroeconomic factors. Students, what is gross domestic product? So, gross domestic product is the sum total of the monetary value of the goods and services produced in the economy during a specific period. So, how does this affects the stock prices or the stock market? If there is a growth in GDP rate, it is advantageous to stock market. If there is a decline in GDP, it indicates a potential economic slowdown. So, for example, in 1990, there was a rise in the Indian GDP growth rate with the opening up of Indian markets to foreign direct investments and foreign institutional investors. The real GDP growth at factor cost increased from 8% during the year 2010-11 to 8.5%. According to RBI annual report, the real GDP growth rate increased for the second successive year after the global crisis, which induced a sharp slowdown in 2008 and 9. So, the GDP affects the stock market directly. Then, how does savings and investments impacts the stock market and hence the stock prices? All of us know that growth requires investment. So how does you get the investment? It is through the considerable amount of the domestic savings. Investment requires savings. So growth and savings naturally leads to investments. High capital investments means possibility of more production, more demand and supply, better prices in the future, and consequently higher business profits and a positive outlook for the stock market. Why? Because savings are distributed over different assets like equity shares, deposits, mutual fund units, real estate, and bullions. The primary market is a channel through which the savings of investors are made available to the corporate bodies. So, if we look at over the years, household and private corporate savings have been increased, which is a good indication of the growth in the stock market and hence the growth in the stock prices of many companies. How does inflation have an impact on stock prices? What do you mean by inflation? So, it is a situation where too much money is chasing too few goods. It means the general rise in prices of goods and services. If the GDP is growing, inflation rate also will increase. Then the real rate of growth would be low. Inflation and stock markets have a very close relationship. That is, if there is inflation, the stock market is adversely affected. The price of stock is directly related to the performance of the company. So, inflation results in high raw material cost, non availability of cheap credit due to rise in interest rates, and also it leads to low earnings. And these factors have the negative impact on stock price and market return. And if there is a mild level of inflation, it is good for the economy and also the stock market, but not the high rates of inflation. Always high rates of inflation is harmful. Then interest rates. These interest rates have direct impact on the economy. Hope you have heard of base rates. So base rates of banks will affect the cost of borrowed funds. The base rate means what? It is the minimum rate of interest at which banks will lend to anyone. It is the floor rate below which the RBI will not allow banks to fund. Okay, so the RBI will limit the rate of interest fixed by the commercial banks. The bank rate range for scheduled commercial banks would be some 8.25 to 9.5%. As of now, for private banks, it would be 8.20 to 10%, and for foreign banks, it would be 6.25 to 11.75%. This base rate is influenced by RBI's bank rate, the repo rate, and the cash reserve ratio. If there is decrease in the interest rate, it means that there is a low cost of finance for firms and hence more profitability. More money is available at low interest rate to brokers who will do business with the borrowed money. Availability of affordable funds encourages speculation and hence the rise in the price of shares. If there is an increase in the lending rates of banks, it affects the firms in a negative manner. Why? Because anybody who is dependent on banks' funds, like speculators who are dependent on banks' funds, will borrow less money as the interest rates are higher, which affects the stock market. So, now coming to budget and fiscal deficit. The budget draft will provide a detailed account of government revenues and expenditures. If there is a surplus budget, it will result in deflation. If there is a deficit budget, it will lead to higher inflation rate and it affects adversely the cost of production. Hence, there should be a balanced budget, which is highly favorable to the stock market. How does tax structure will impact the stock market? Every year during March, the business community will eagerly waiting for the statement from the government regarding the tax policy. Concessions and incentives given to a particular industry will encourage investment in that particular industry. The finance minister during the year 2012-13 introduced tax exemptions for stock market investments to attract retail investors to the stock market. The scheme named the Rajiv Gandhi Equity Savings Schemes allowed 50% tax deductions for those whose annual income was below 10 lakh rupees and who invest up to rupees 50,000 in stocks, subject to a 3-year lock-in period. This kind of tax policies will definitely impact the stock market in a positive manner. Balance of payments. What is balance of payments? It is a statement of countries' money receipts from foreign countries and payment to foreign countries. This difference between the receipts and payments would be either surplus or deficit. Balance of payments it is a measure of the strength of the rupee on the external account. If the deficit increases, the rupee value will depreciate against other foreign currencies, which affects the cost of imports. And industries that are involved in the exports and imports will get a huge effect with the changes of foreign exchange rates. The volatility of the foreign exchange rate will affect the investment of the foreign institutional investors in the Indian stock market. Hence, the favorable balance of payments will have a positive effect on the stock market. Foreign direct investment. According to the International Monetary Fund, what is foreign direct investment is? It means it includes different elements like equity capital, reinvested earnings of foreign companies, intercompany debt transactions, short and long term loans, financial leasing, trade credits, investment made to foreign venture capital investors, and etc. How does these FDIs helps the stock market? FDIs will help in upgrading the technology, skills, and managerial capabilities and brings much needed capital into the economy. It helps in providing employment opportunities, inflow of capital helps the economy grow and has a positive impact on the stock market. Next is investment by foreign institutional investors. Actually, these FIIs are considered to be the main drivers of the stock market. Outflows of FI investment affect the stock market negatively. For example, a report, according to the report in the Times of India, during April 2012, the investments by FIIs in the stock market were the lowest of the past 3 years, that is past 2012, and it was stood at rupees 47,935 crore. So always foreign institutional investments is very important for the growth of the stock market. And international economic conditions also affects the stock markets because worldwide economies are not independent, they are interdependent. The boom or the depression in one country would affect other countries and also the stock market. For example, the US subprime crisis, bankruptcies affected the other countries and also the stock market. A 29% drop in the Dow Jones happened during the US subprime crisis, and Nasdaq also had an impact, and also there was an impact of the US subprime crisis on the Indian economy. IT industries, financial sectors, real estate, the automobile industry, investment banking, and other industries faced heavy losses. Also, the global recession resulted in the pulling of FI funds from the Indian stock markets. During the year 2008 in India, the Sensex plunged and became highly volatile. Business cycle and the investor psychology has a great impact on the stock market. The business cycles contain four phases with distinct features like boom, recession, depression, and recovery. During boom, economic activity will be at the peak. The growth of industry and GDP are prominent. Companies record high turnover and profits. They engage in expansion plans, mergers, acquisitions, etc. This will lead to the optimization of the investors' investment. Retail investors, big and small, are enthusiastic about market and they are willing to invest. The market will reach a new high. Some companies may fail to fulfill the goals, and as their profit margins fall, the next phase of trade cycle will be a recession which will set in. Economic growth will decline, there is an economic slowdown, the stock market reacts with a fall in prices and volume of stock. Fear grips the market, the recession slips into depression. It results in additional fall in growth rates and increase in unemployment. The investor becomes pessimistic about the market. Panic will prevail and stock market reaches a low level. After a while, the economy will slow down and begins to recover. Some entrepreneurs begin to realize that things cannot get any worse and start investing. The recovery starts in the stock market. The mood changes to hopes and caution. Once again, the cycle goes on. Hence, the different phases of the business cycle will have different impact on the stock market. How does monsoon and agriculture affects the stock market? In spite of technological advancements, Indian agriculture is still dependent on the monsoon. Good monsoons are a boon for agriculture. Agriculture is directly and indirectly linked to many industries. For example, the sugar, cotton, textile, food processing industries depend upon agriculture for raw materials. Farm equipment, fertilizers, and insecticide industry will supply the inputs used in agriculture. A favorable monsoon leads to higher demand of these inputs. A good crop and more disposable income in rural areas, which leads to buoyancy in the stock market. When the monsoon fails, agricultural production and hydropower generation will decline. They cast a shadow on the share market. Infrastructural facilities. Good infrastructural facilities affects the stock market favorably. Infrastructure facilities are very much essential for the growth of the industrial and agricultural sectors. A wide communications network is a must for the growth of the economy. Regular supply of energy without any power cuts will enhance the production. The banking and financial sector should also be strong enough to provide adequate support to industry and agriculture. In India, even though infrastructure facilities have been developed, they are not sufficient. The government has liberalized its policy for the communication, transport, and power sectors. For example, the power sector has been opened up to foreign investors with assured rates of return. Demographic factors have also an impact on the stock market. Like demographic data will provide details about the population by age, occupation, literacy, and geographical locations, which is needed to forecast the demand to consumer goods. The population by age indicates the availability of a skilled workforce. The cheap labor force in India has encouraged many multinationals to launch their venture. Indian labor is cheaper compared to its Western counterpart population by providing employees and demand for products affects industry and the stock market. Hence, all these economic factors have to be analyzed carefully for making the decisions on the exit and the entry points in the stock market. So we learned which are the economic factors that in fact impacts the stock market as a whole. But how do you forecast the economic conditions? So there are many economic forecasting techniques to estimate stock price changes. Hence, an analyst must look at the macroeconomic environment and the factors peculiar to the industry he is concerned with. Economic activities affect corporate profits, investors' attributes, and share prices. A fall in GDP or a slowdown in the economic growth may lead to fall in corporate profits and consequently the stock prices. For the purpose of economic analysis, an analyst should be familiar with the forecasting techniques. He should know the advantages and disadvantages of various techniques. The commonly used techniques are diffusion index, surveys, and econometric model building. These techniques help an investor to decide the right time to invest and the type of security he should purchase. That is, whether he has to purchase stock, bonds, or some combination of both. And students, I'll be not going into detail about these economic forecasting techniques as it is out of syllabus. So these are some of the factors that an investor or an analyst has to analyze before he invests in stock market. Hope you understood. Please watch this video so that you will understand the techniques, the economic factors that impacts the stock market either positively and negatively, which helps you in taking investment decisions. Thank you.